So very simply, zones that have no inducement, it's basically a fancy way of saying there's no available liquidity in front of the zone, right? So if you were to look at the zone initially, you might think, right, well, it's just about led to a break of structure. Big amount of supply must have come into the market there, right? Tons of momentum. It looks super clean. So why has it failed, right? Likewise, again here, another clean zone led to a big bullish push. I'd definitely expect that to hold, maybe. Why has it failed, right? And it's to do with the idea of inducement, okay? So give you a quick crash course. So the easiest way to think about this is just imagine for a minute that you are a massive institution and you need to put huge orders through the market and you want to buy, you want to get long. What do you need? You need people who are selling to you, right? Because for every buyer, there must be an equal seller, right, for a trade to take place. So imagine if this was the order book where you can see the amount of liquidity at each price level, and let's just say you wanted to put $700,000 long right through the market. Well, there's only 500,000 at this level, then that would be a 600,000 filled. So price would have to jump all the way up to here, right, to fill your order. So when you're getting long, you want to get long, right? You want to buy at the lowest price possible. You don't want to get slipped when you enter the market and have to get your price filled all the way higher up, right? You want to get in as low as possible. So if you are a big market participant, where are you going to want to transact? You're going to want to transact if you're buying where there are tons of sellers, right? When there's that opposing liquidity, okay? So this whole idea is we want to find those areas in the market where there's going to be opposing liquidity, where we think that those big players are going to be trading in the opposite direction. And that is where the idea of inducement comes in, okay? And inducement is essentially encouraging market participants to generate liquidity in a certain area, okay? So anywhere where you see lows in a market, so obvious equal lows, or say like a low that actually broke some structure, what is that going to do? It's going to induce sell side liquidity below those lows, right? For multiple reasons. If you see obvious double bottoms, or if you see a low that broke a high, right? People are probably going to want to buy from that level, right? Buy from the support level or buy from that low, right? When they see that trend change, they're going to buy there. So if you've got long, where the stop loss is going to be, it's going to be below the lows, right? Below that low that broke the high, okay? And that's going to produce that sell side liquidity. Or some people will see, right, well, that's a strong level. So if we break below that, I'm going to want to sell the breakout, right? So both scenarios, for whatever reason, when you see either very obvious lows or a strong low that broke structure, it's going to induce and generate sell side liquidity below those lows.